So in today's video, I'm going to talk about guaranteed annuity rates. Now, an annuity is a fixed income for life. So you could compare it to the income stream from a defined benefit pension. At a normal retirement age, the client will receive a fixed income for life, and it's possible, or usually possible, to build in things like a spouse's pension and indexation and a guaranteed period. So you might have come across defined contribution schemes which have got guaranteed annuity rates built in. So usually the way that this works is once the client reaches the normal retirement age of the scheme, they'll be able to take an annuity and there's a guaranteed annuity rate. Historically, maybe we go back to the 1980s or 90s, annuity rates could be as high as 15 or 20% per annum. Whereas in today's market, for a 65-year-old man who's a non-smoker, you're probably looking at around a 4 or 5% annuity rate. A lot of the time when you come across these guaranteed annuity rates, they might be as high as 10 or 12% a year. So you need to think about whether it's worth the client remaining in that defined contribution scheme and taking the annuity, or perhaps transferring to another scheme which might offer flexi access drawdown, but they'll lose the guaranteed annuity rate. Now, the reasons why annuity rates used to be so high is largely down to life expectancy. Back in the 90s and 80s, if a 65-year-old man came to draw his pension, there might only be a chance that he could live for another 10 or 20 years. So why would you keep a guaranteed annuity rate? So first of all, it could be because the annuity rate is a lot higher than what's available on the open market or than the income that could be withdrawn from a SIPP. As life expectancy has significantly increased over the last 10 to 20 years, the annuity rate might be based on the life expectancy figures from the 1980s and 90s. And also, as we're in a low interest rate environment, the annuity rates which are available now are much lower. Secondly, it could be because of the investment risk. If a client is to transfer to a SIPP, they take on that risk, they might not be comfortable with that. And finally, it could be because of the death benefits, and if there's no need for a pension to produce any death benefits, the client might prefer to leave the money where it is and take the annuity, rather than having a capital asset in a SIPP which can be passed on to their beneficiaries. Why would you give up a guaranteed annuity rate? It could be because of the structure of the existing pension contract. These schemes that have got guaranteed annuity rates normally have been set up 10 or 20 years ago, so they don't offer all of the functionalities of a new modern pension scheme. So that might be down to the investment choice. It's usually very limited, might only be in with profits funds, and also we look at the cost of the existing scheme. Usually these schemes are very expensive, they might have monthly admin fees. Also, it might be because the guaranteed annuity rate has to be taken at a fixed age, which is normally 65. And finally, if the client is in poor health, it might be possible for them to get a higher annuity by taking an ill health or an impaired life annuity, because that will offer them more money on a monthly and annual basis because of their reduced life expectancy. What to do if you come across a client with a guaranteed annuity rate? So first of all, I think you need to look at the income projections. You need to map out what they could get with the guaranteed annuity rate payable from the retirement age of the scheme, and compare that to the transfer value that's been offered, and look at whether the client could still draw the same level of income and have capital left maybe when they get to 85 or 90, or whether that capital will be depleted. You also then need to think about the client's objectives and their circumstances. So looking at things like what other assets have they got, do they need to produce a spouse's pension, and do they want a pension that's going to increase in line with inflation, or are they happy to take a fixed level of income or perhaps take on that investment risk from a SIPP? The FCA considers a guaranteed annuity rate to be a safeguarded benefit. Therefore, if the transfer value is over £30,000, we need to take regulated advice from the UK. There is a cost involved with this, and it does add time into the process. However, as it is a guaranteed benefit and a safeguarded benefit, it's important that the client receives UK qualified advice to analyse their benefits.